Good morning. As Curtis pats out the outline we're using today for federal income tax, there's two different scriptures to apply to today. A lot of thoughts about tax, that what's it have to do with us as Christians. Believe it or not, we're not the first country to pay for leadership or rule. As you'll read today in the scripture, Matthew 15:22, it's been going on a long time. Just so happens in 1913, our Congress decided to make it permanent. In 1916, they started collecting federal income tax. But way back in the day, they tried to trap Jesus in their conversation. Said, "You're our teacher, you're the smart guy. Should I pay this tax to Caesar?" Jesus said, "Flip me the coin." So he flipped him the coin, and he looked at it and said, "Whose picture's on the coin?" And people said, "Caesar." Well, he simply said, "What belongs to Caesar, pay to Caesar. What belongs to God, give to God." He probably said it tongue-in-cheek because Caesar, as well as the rest of us, is all created in the image of God. So effectively, he was saying everything's going back to God anyways. Don't worry about it. And the second scripture you'll get will be Romans. It pretty much says, pay your taxes. Get over it. Forget about it. Don't leave any debts behind. What you owe is love and respect and friendship and honor. That's what you pay to others. Leave no other debts around. So this federal income tax issue is something it's been around forever, and you'll continue to have the burden of the income tax. And we're trying to help you adapt to the new one today. Sean will be doing the tax explanation. He doesn't know it yet, so don't tell him. He's sitting right there. He does about 1,000 individual tax returns, so I think he has a handle on this. Of course, it's all new this year for everybody. I know we all think we pay too much income tax. Everybody has that feeling, and that's what Matthew is kind of saying. Get over it, forget about it, pay it. Don't leave any debts around. Just as a perspective, the top 1% of our income producers in this country, those are people making more than $460,000 a year. That group of people actually earns 20% of all the income in this country. 1% of the population earns 20% of the income. But they also pay 40% of the income tax bill. So be careful what you wish for. We all feel overburdened with taxes. But this tax concept this year is it's better. It's improved. It should save you taxes. Most people it will. At this time, I'm going to introduce you to Sean Dowler, my tax man.
Hello everybody, thanks for coming here today to learn a little bit about the new tax codes for 2018. We give you this handout today just to kind of go over some of the generalities, the different things that are going to affect most people. You know, there's going to be some questions afterwards, and anyone that wants to speak a little bit, you can feel free to raise your hand or wait till afterwards, and we can answer some questions for you at that point in time. The first page there talks just generalities when the tax code was put into place at the end of 2017. It affects the years 2018 through 2025. As of right now, if there's no changes made, the rules go back to what they were in prior years, 2017 and prior. Is that going to happen? You never know. I mean, there's no such thing as a permanent tax cut because people can change things on a yearly basis. The very top thing that they did there, they changed some of the brackets. You can see for 2018, there's a 10, a 12, a 22, a 24, a 32, a 35, and up to a 37% income tax bracket, which is down from the previous year from 10, 15, 25, 28, 33, 35, and 39.5. Below that, I just put together some of the tax charts for the different filing statuses, whether you be single, married filing joint, married filing separate, and head of household. I don't have the tables on there for 2017. As my dad said, most people, there was a benefit from this, whether it be $500, whether it be $20,000. It really affects on your individual circumstances to say for sure how much. You know, that's the first question everybody always asks me is how much is this going to save me? And it's really hard to say until you see a copy of their tax return in their specific situations. To get away from the individual taxes, I just want to go down to the next section there for the estate tax exemption. You can see the estate, people always ask when someone passes away, how much do I have to pay in the estate tax? For federal purposes, it's almost nearly 0% because you can see that you have an exemption of a person of $11,200,000. So if your federal estate is under that amount, you don't pay any federal estate taxes for anything. Most of my clients are well under that, so we don't deal too much with the estate tax stuff there. When it comes to Pennsylvania, Pennsylvania is a little bit different. Pennsylvania, if a husband and wife, if one of the spouses passes away, all of their assets go to their surviving spouse, unless dictated elsewhere in their beneficiaries or will or something like that. So there's no tax paid whatsoever. After the second spouse passes away, depending on who gets their assets, there is what's called a Pennsylvania inheritance tax at that point in time. If it goes to your children and your beneficiaries, they pay a rate of 4.5%. If it goes, there's a 4.5% for the children, it goes to 12 for brothers and sisters, and any non-blood relation, it goes to 15% at that point in time. And that's based on date of death values for checking accounts, houses, IRAs, nearly any asset that you have in sole name. Another question I get quite a bit is, how much can I give away before I have to file a gift tax return? You can see for 2018, that number is $15,000. And that is per person there. So a husband and wife, as I show here, can give $30,000 away to their children and not have to worry about filing an estate tax return.
And that's each child.
Each child, correct.
So you have up to $15,000 for, or you give me $15,000.
You can give it to anybody, and there's no federal
I'm not
income
saying,
tax.
I'm just saying.
People always ask, say I give my child $100,000. Clearly that's over the $15,000 or $30,000 limit that you're allowed to give away. So at that point in time, you have to file a gift tax return. Now with the gift tax return, there's no taxes actually due on that. Not the person receiving it, not the person paying it. What happens is it's an informational return that goes to the IRS at that point in time. And then when that person, the person who donated the money, passes away, the IRS goes back to look to see how many gifts over top of that $15,000 exclusion did you give away. They add everything up and add the rest of your estate up. If it's over that $11,200,000, then there could be some estate taxes at that point in time whenever the person passes away. Some other changes for 2018, you can see those are the standard deductions are an X list down there. They went up very significantly for this year. For a single person, it went from $6,500 to $12,000. Married filing joint, it went from $13,000 to $24,000. And that number does increase depending on if either one of the taxpayers is over 65 or blind. You get an additional amount added to that standard deduction. Married filing separate, it went from $6,500 to $12,000. For head of household, it went from $9,550 to $18,000. However, they did, as I mentioned a moment ago, the increase in the standard deduction is great. However, what they give you one side, they take away on another. They got rid of personal exemptions for 2018. A personal exemption is for each person in your household. You've got, for 2017, you got $4,050 you got to subtract off your taxable income. So someone that was a married filing joint couple with 2 kids, they had a $22,000 personal exemption at that point. $20,200 personal exemption you got to subtract off your taxable income. That is no longer applicable. That is gone at this point in time. So they helped you by increasing the standard deduction significantly, but then they took away the personal exemptions. Another good thing with the new tax rules are the child tax credit. In past years, it was always for children under the age of 17, you got a $1,000 tax credit for each person under the age of 17 there. And that was phased out if your income, your adjusted gross income got between after it got over $110,000, they started to phase out that child tax credit. The new child tax credit is $2,000 per child, so it's double, and also the income threshold went from $110,000 before it starts to be phased out to $400,000. So there's a lot more people this year that are going to qualify for that $2,000 child tax credit. Section 529 plans, new for 2018, you're allowed to take up to $10,000 a year out of those plans tax-free to be used for elementary school, junior high, private high schools, In past years, it only could be used for college education expenses. They changed it so you can use, like I said, up to $10,000 a year for under college education, essentially. Another big change this year are with the itemized deductions. You can see that except for the state and local income tax, mortgage interest, medical expenses, disaster losses, charitable contributions, and other deductions not subject to the 2% floor, all other itemized deductions were repealed. And what does that mean, you may ask? We'll go to the next page and kind of explain some of those things. State and local taxes is many taxpayers' biggest deduction. State and local income taxes, along with real estate taxes on your house, on a second property, your state taxes, your local taxes that come out of your wages, those are all an itemized deduction. They're still an itemized deduction, however, they capped it at $10,000 at this point in time. So if you have an $8,000 real estate tax bill and you pay $5,000 in state and local taxes for a total of $13,000, you're only allowed to, it's capped at $10,000. Medical expenses, those are supposed to go up to 10% for 10% of your AGI. However, they kept it at 7.5% to be able to deductible. Meaning, if you have $100,000 AGI, you need to have $7,500 in medical expenses. Then only the amounts over top of that qualify as an itemized deduction for everything. Now, a lot of people ask that are working, are my health insurance premiums counted towards that? Most employers, if it's an employer-provided plan, the premiums that they are paying are pre-tax, so those are not deductible. However, a lot of people that have Medicare that come out of their Social Security or have Advantage plans or supplemental plans, they're paying those premiums out of pocket, those go towards that 7.5%. Other things that would go towards that would be prescriptions, co-pays, if people reside in a nursing home, a portion of that, depending on your level of care, can go towards the medical deduction there. Travel expenses, I think they're giving you, I don't have the exact mileage here, I believe it's 17 cents a mile, or actually it might be 23 cents a mile for medical this year, so driving to the doctor, that sort of stuff there, if you keep track of your miles, that all goes towards being able to surpass that 7.5% of your AGI, then those amounts over top of that count towards your itemized deductions. Charitable contributions, they raised the limitation up to 60% of your adjusted gross income that you're allowed to deduct. Say you make a very large donation that happens to be more than 60% of your adjusted gross income. You don't just lose out on that percentage, it carries forward to the next year, so that if you're below it the following year, you get to take your carryover. Mortgage interest, in past years, you were allowed to deduct the mortgage interest on $1 million worth of qualified mortgage interest. They lowered that to $750,000 this year. Down below that, I talk about some of the itemized deductions that are no longer deductible. And this was one that a lot of people don't really like due to the fact that your employee expenses, things that your employer require you to do, are no longer deductible. And some of those examples are your employee business mileage, so people that are sales and they go out and they put 20,000 miles a year on their car and their employers don't reimburse them for that mileage. Unfortunately, that's no longer deductible. It's the same thing that goes if you have to buy special supplies for your company that they require you to do that they don't reimburse you for. Those are no longer deductible. Union dues, uniform expense, employee meals and entertainment. Here's another big one here. Your advisory and management investment fees are no longer deductible on your income tax return. So if you're paying $20,000 a year in investment fees that have always been deductible in the past, they're no longer deductible. Same goes with the cost of tax preparation or your tax preparation software that you may buy. Casualty losses, deductions for unexpected losses to personal property are no longer deductible unless you're covered by a specific federal disaster declaration, such as a hurricane or a flooding issue or something like that. Moving expense reimbursements through your employer are no longer deductible unless you're active duty in the military. Alimony is a big one. Some of my tax books say that 2018 is going to be the year of the divorce. And the reason for that is, under current rules, the person who pays alimony is a deduction for them. The person receiving the alimony is income to them. Going forward, that's no longer the case. So the person that's paying the alimony does not get a deduction, and the person receiving the alimony is no longer income to them. The Affordable Care Act, the biggest change for that is the mandate that requires people to have insurance is going to be repealed at the beginning of 2019. So anyone that chooses not to have health insurance in 2019, there's no longer a tax penalty for doing that sort of thing. The pass-through businesses is one of the big benefits to a lot of small businesses. You can read the paragraph, but the short of it is they are going to allow you to deduct 20% of your net profit as, I don't know where they're going to put it on the tax form, but you're going to allow to deduct $20,000 of your net profit from your taxable income, which can be a huge savings for someone. If they have a $100,000 net profit, they're going to allow you to deduct $20,000 of that from your taxable income. You're still going to have to pay the self-employment tax, which most self-employed people, that's the biggest tax that they do pay. That 20% deduction does not lower their self-employment tax, it just lowers their taxable income is what it's going to do. It does get phased out. You can see with income between $315 and $415 and $157 and $207 for single and married filing separate. Some miscellaneous information for 2018. The business mileage deduction for self-employed people is 54.5 cents a mile this year. The maximum student loan interest deduction is $2,500. That has stayed the same, that hasn't changed. It does phase out once your income reaches a certain limit. And the educator expense for teachers for their out-of-pocket cost for their classroom supplies, they did keep that in there. That's not an itemized deduction. That's an above-the-line deduction, an adjustment to income, and it is limited to $250. Some general stuff about Pennsylvania tax laws. For a lot of people, retired people, you can see if your Pennsylvania taxable income is under $6,500 and between $6,500 and $8,750 for a single person, you don't pay any Pennsylvania income tax whatsoever. For a married filing joint couple, that increases from $13,000 to $15,250. Now what that means is, if your Pennsylvania taxable income, and for retirees, please remember this does not count your Social Security, this does not count your pensions, this does not count your IRA distributions. This is your interest earned, your wages earned, your self-employment income earned, your investment income, interest and dividends, and capital gains. If the total of those that income is less than those amounts we talked about, you don't pay any Pennsylvania income tax whatsoever. So a lot of retirees in Pennsylvania don't pay Pennsylvania income tax because most of their income is derived from Social Security, pensions, and IRAs. 529 contributions are deductible for the state of Pennsylvania, up to $15,000 a year per beneficiary. So if you do the max, say $15,000 times 3%, that's going to save you some money on your Pennsylvania income tax return. It doesn't make sense to do that if you already aren't paying Pennsylvania income tax return. So I tell some grandparents that want to put money in for their grandchildren and aren't going to get the tax benefit to take the $15,000, gift it to their child, their kids who are working. They can take that $15,000 and deduct that off their Pennsylvania income tax return. So they get the deduction. The grandparents weren't paying any income tax anyway, and then the grandchild gets the benefit from having a 529 plan contribution made in their name. Some of those employee business expenses we just went over for the federal government, those are that were no longer deductible for federal purposes. They are still deductible for the state of Pennsylvania. But please remember, more letters that we get in our office have to do with this. Pennsylvania is very strict when it comes to writing off your expenses. So if you don't keep good records such as travel logs and getting letters from your employer saying you're required to do these sort of things, Pennsylvania's going to come after you, and you're not going to have the documentation to back it up, so it's sometimes not worth even doing. A lot of PA seniors may qualify for a property tax rebate if your income is under $35,000, and that's the one that you see all the time that says, the Pennsylvania Lottery benefiting older Pennsylvanians. That's the program that they're talking about there. So income purposes for that, they take half of your Social Security, and you add all of your other sources of income to it. If that number is under $35,000, you can qualify for a rebate from the state of Pennsylvania. I'm going to let my dad talk a little bit about the charitable giving.
I'm not sure if you can recognize that the new federal tax law is an attempt to make it a smaller, shorter tax return, as they advertise it, to fit on a postcard. We still have a self-determining tax system in this country. If they send out a postcard sometimes says, line 1, how much did you make? Line 2, send it in. We get issues. Till then, we have rules, and the rules are being minimized, but they're also, as you can see, they're helping different groups of people. Self-employed, they've helped corporate America out significantly with the new tax law, so then they figured, well, we better help self-employed small business owners, and that's that one deduction where you get up to 20% of your net profit as a deduction. It will simplify the tax return for you, maybe, but you still have to determine your different classes of income. You'll need help defining my capital gains, my interest, my pension, my Social Security, my IRA distribution, etc., etc. And regarding your IRA, a lot of them is made permanent. If you chose to take your IRA distribution out, either in part or in whole, and if you're of that species 70 and a half and older, you can choose to have that IRA distribution taken out and not pay tax on it. It will not show up on your tax return. It'll be totally tax-free. It has to go specifically to a nonprofit tax-exempt organization. That's a nice play for many, because now the new tax law says if you're a married couple over 65, we're giving you $26,600 right off the top of your income. You don't have to itemize anymore. And in addition, if you have an IRA distribution, be it $5,000 or $10,000, and it goes directly to a church, that doesn't show up on your income. So you've minimized your income, but you maximize your deduction because the federal government's giving you a $26,600 right off the top. So you need to discuss with me or someone in the church, Gary Merge, or anybody that has an awareness about the tax code and IRA distributions, to do the Qualified Charitable Distribution, QCD. It can be significant if you're a giver, and if you choose to give that way, tax-free, and if you're 70 and a half or older. It is an immense thing, specifically since they changed the tax law and gave you a larger standard deduction, which could help you if you show less income and have a larger deduction. The bottom line is smaller taxable income. The tax rates are smaller, so presumably you'll pay less tax. Does paying less tax each year mean you're going to get a refund? Probably not. No larger than last year's anyways, because January 1 of 18, everybody started taking less out of your Social Security, less out of your pension, less out of your wages. So even though your tax liability will be lower, you'll have less withheld. So you won't recognize a larger refund, but you will indeed pay less income tax, bottom line. Item 2 under charitable giving, contributing appreciated assets. We have people that, and we're set up in the church, if you bought a mutual fund for $500 20 or 30 years ago, now it's worth $2,500. You have a buy one, get one free thing, giving appreciated property to a church. It's simply that if you cash it in and take the $2,500, you're going to pay some income tax, usually 15% and then 18% of your gain. So you might pay $500 to $700 income tax. If you give it directly to the charity of choice, you get no income tax on it because it went to a charitable organization. But you also could, if you have enough itemized deductions, because the one deduction that the federal government did not mess with is charitable giving. They minimized, to a degree, the interest on a home. People on the West Coast that have high appreciated properties don't like that. They minimized the tax. Local, state, and real estate tax you can deduct at $10,000. Well, if you own 2 homes and one's on the east or west coast, you're probably paying a whole lot of real estate tax that you're not going to be able to deduct. And a lot of the state taxes in other states are much higher than ours. So by minimizing the state tax deduction, that's hurt a certain group of people. And then item 3 on the last page, substantiation. Pretty much standard for the 45 years I've been in the tax business is ignorance is no excuse, number 1. And number 2, substantiation wins. Records, contemporary track records, appointment books, those things will work in an audit. Travel logs, or work repair orders on a car. If you're self-employed and you say, John, I drove 20,000 miles this year. I said, where's your travel log? Okay, how do we prove you drove 20,000 miles? Do you have work orders? Oh yeah, I had an inspection in January and then I got tires in December. That has your mileage on it. IRS would accept that as proof that you drove that vehicle 20,000 miles. Substantiation, verification, record keeping, critical. When I do a church contribution, someone gives us appreciated property, I place it into a stock account, I give the cash equivalent to the common good fund, I send you a letter substantiating the day you gave the stock, the average value of it that day, and saying that you received no services for that. It was purely a gift to the church. You have to have substantiation, particularly contributions. People give a lot to Goodwill and Salvation Army, material old things, and valuing those and getting receipts is critical if you want to win that deduction. So at this time, we're going to open it up to any... Oh,
Sean,
Just a couple minimal things. Back to that qualified charitable distributions. Another good thing about doing that is, as my dad mentioned, it's not including your income at all. So normally, if you would take $10,000 out of your IRA and give it to the church, the $10,000 would show up in your adjusted gross income, but it wouldn't show up in your taxable income. If you just give the $10,000 as a qualified charitable distribution straight out of your IRA, it doesn't show up in your adjusted gross income either, and that can be a good thing for a lot of people that are on the cusp of their AGIs, making them pay higher premiums for Medicare Part B and D there as well. So if that's a situation there, it makes it more, you're going to have the same tax benefit from everything, but it'll lower your adjusted gross income or keep it lower because your adjusted gross income is usually based on a lot of different benefits you get for things. So the lower your AGI, the more benefit you get from different situations right there. One thing he mentioned, there's all the stuff that we're talking about here is not specific to a certain person. Each person's return is unique. There's no two situations that are exactly the same. So some of the things we're saying here may benefit you, some of the things we won't, some, you maybe need some more information about it right there. These are just generalities that we're going over right here. So if you do want some more specific advice or have any other questions, then feel free to reach out to one of us and we can sit down and talk to you about it. But these are just general, and everyone's return is different. So there's some things that are going to benefit you, some things that aren't going to benefit you. So if you do have questions, please ask.
okay, along those same lines, so you understand, everybody that's collecting Social Security pays a portion towards their health care, towards Part B. You would think that everybody paid the same $120 a month, but they don't. If your income's too high, you can pay $250 or $275 a month because of income base. As Sean said, the lower we can get your AGI down, your adjusted gross income, by maybe not being taxed on an IRA distribution, it may keep you from paying a higher Medicare payment, or it may make less of your Social Security taxable because your Social Security tax liability is based on your adjusted gross income, your total income. So it's important to have these issues looked at if you're concerned with them. Any questions at this time? Please. Yes, Mr. Bill.
What level does your income have to be before you start paying more Medicare?
I have the numbers here for 2017. I don't know, they adjust them a little bit for inflation, but
I believe it's at about...
For a single person, it's around 90,000, and for married filing joint, I'll look it up here for you right now.
Yeah, it's a sizable increase, but if you're, I believe it's 160, 150 for couples, and 80 or 90 range for single people. So if you can keep your income under those thresholds, you indeed could save yourselves a monthly fee, extra fee going to Social Security, Medicare, Part B. Good question. Any others?
Yes.
Yeah, go ahead, Ms. John. We got every John raise his hand.
About the property tax rebate program.
Yeah.
I understand, I'm not sure when it was enacted, but I think it was like 1986.
It's been around for a while.
It's been around, and they have a fixed limit back then when they wrote the law of, let's say, $12,000 to get the maximum
Right.
tax credit of $750, or the rebate. But that basically is like below poverty. And so there's been adjusted, or what's the,
Cost of living
COLA.
Yeah, cost of living adjustments. Cost of living adjustments.
Right, so that's up for vote again.
Okay.
And so I was told, just write in the COLA anyhow, and then if it doesn't go and get voted on or passed, then you make an adjustment. How do you do that
On the property tax rebate, the property tax rebate form. I mean, once again, I don't have the form here in front of me, but most people get the minimum, which I think is $250 and that sort of thing. So I'd have to look into the cost of living adjustment aspect of that right there. I'm not familiar with that.
Yeah, I would think the forms have to be adjusted by the lottery people in conjunction with the state. 'Cause when we get a form, it has specific guidelines on it, and I don't know there's a way to circumvent those guidelines. I mean, if it says $35,000 at the top, and you're $35,001, and you're getting nothing.
You get cut.
Yeah.
And what happened was, my mother applied for the maximum, and it was $47 over. And what happened was, we appealed it, and then we got a letter from the judge saying, oh, but cost of living adjustment way back here, when you first applied and had it, you get to hold that same level of income, regardless of what you make now. Because basically, Social Security increases, and this year is supposed to be even
Substantial,
greater
right.
increase.
Right.
So it was just, how do I do that?
You better call the lottery people, because I don't know.
It's probably in your booklet. You should get the booklet every year in the mail.
It doesn't say
It doesn't
anything
make
about
a
the
cost of living
Yeah.
adjustment in there right there. I know a lot of people will apply for $500 and the state ends up giving them $600 or something like that, and I never have an answer why they're doing that. So it may have to do with what you're saying, the cost of living adjustment, that when they get the paperwork, they make the adjustment.
And where you get the numbers for the cost of living adjustment. But I was told just to put an asterisk and put COLA beside the number that you write in by Market Sec's office.
Sure, okay, that may be the case then.
Okay, I don't want to take
Yeah.
up all your time.
John?
I think I might have answered my own question, but can you portion an IRA distribution any way you like?
Yes. As long as you meet your RMD, it could be more than your RMD, or you can take your RMD. If your custodian of your holder of your IRA will make two distributions. For example, if you had $6,000 coming, UMD could send 3 to your own address of record and 3 to the church. But that's up to your custodian of your IRA. If they'll do that, and I've done that, certain ones will, certain say, no, we're only cutting one check. Well, that kind of shoots that strategy down unless you give 100% of your RMD to the church. But the answer is yes, you can do two distributions.
Most cases based on the custodian.
Custodian of your, whoever holds your IRA. It's kind of in their hands.
Bill, that number you're looking for was 170 for married filing joint couple. So once you're aging, it's actually modified adjusted gross income, which for most people it's the same as their AGI, but it's 170 and above, you jump to the next bracket. For a single head of household, it's $85,000 at that point in time before you jump up to the next, having to pay the higher premiums under Part B and B.
Yes?
Under the new rules, can a 529 be used to pay for preschool?
I don't know that.
Preschool, I don't know if preschool would qualify. I mean, that's something that we should look into there. But it has to be used, it's supposed to be used for tuition and that sort of stuff. So I don't know if preschool would be considered tuition. But preschool does qualify for the child care credit for everything. Kindergarten is not, preschool does, because they still consider that daycare for the child care.
But then both parents have to work, you're looking.
You are correct there, yes, both parents do have to have income in order to qualify for that, yes.
I will tell you an application for that new $10,000 rule for secondary education or elementary education. A lot of my clients' kids chose to take all these summer classes at college to get credits before they went to college. While they're in high school, they're taking their advanced degrees in school, or their advanced courses in high school and getting college credits, but they're also going summer. So you can pay for the tuition for those, because then when you get to college, they may have 30 or 40 college credits, end up only having to go for 3 years instead of 4. So I could see an application of taking some of that money out of the 529, sending to CCAC or Westmoreland and getting college credit level courses. And then when they go to college, they could be out in 3 years if they chose to. So this is a pretty good application of that $10,000 529 rule for secondary education. I think that would qualify nicely. Any other questions? Yes, Rodney.
If we want to take out of our IRA and send it directly to the church, that qualifies as our church contribution.
Well, you do not get the deduction. No, you do not get the deduction, but you also don't pay income tax. It does not show up on your tax return. You don't get both.
You don't get both, but it shows it's a lower income.
Exactly. It reduces your income dollar for dollar, but you don't get an itemized deduction. And that's why we're saying, because the government's giving you such a large standard deduction, $26,600 for two 65-year-olds, that's not real large, but it may, you have to look and see, is it better to get, usually reducing your income dollar for dollar is better than saving income tax on that same amount, usually, because you're reducing your income.
One other note on that, it has to go directly from the organization to the organization. It can't come to you and then you cut a check back to the church or whomever the organization is.
Check has to be directly
One
named to the
custodian
church.
charitable organization.
Have a form, does the church have a form?
Every IRA company has their own form.
Yes.
You'll do it through the custodian of your IRA.
Okay.
And I'll help you fill that out if it's concerned. It's very clear now. When it first started 6-7 years ago, and it wasn't a deduction, they always made it a deduction in December for the previous year. Like, okay, I have 12 days to get this done, and no one can do it. Now the deduction is permanent. So you have some time to plan for it. You still have 2.5 months left to get the form and know how to fill it out, send it in, and they will distribute the money accordingly. But it's through your custodian, the holder of your IRA, the paperwork. Yes?
I have a little different question on charitable giving. Say you donate your car to Habitat for Humanity or whatever, and you get a letter from them saying it was worth something. Does that reduce your income, or is that just a deduction?
It goes towards your itemized deductions. So if you're, depending on what your situation were, if that number helps you itemize, then it does reduce your taxable income at that point in time. But it might not help you at all due to the fact that even with that number, you might not have enough to exceed the standard deduction, so you may not get a benefit from it whatsoever there. But it could, and once again, that's a specific situation sort of thing there. I know with the donation of cars, it's actually a kind of a tricky thing, because it's not the year you make the donation, it's the year that they sell the car in. And then the organization gives you a form saying, you donated on this day, the car was sold on this date, and then when it comes to a car, you actually have to attach a specific sheet to your tax return that shows that information right there. It's not like when you give money to Goodwill, if you say I gave $200, you get a little slip. It's a little bit more detailed when it comes to the car.
But it can only be used if you itemize.
Correct, correct.
Anything else? I really want to thank you guys. It's a great turnout, and it's a tribute to our church. The last week we had 26 or 30, and a nice turnout today, and I'm glad you're taking advantage of these talks. Next week, Curtis will be talking about spending money and family budgeting, and then Gary Merge, the last Sunday, will be talking about retirement. So he's a CFP and a CPA. He's got a lot of good thoughts. So thank you, and if there's any individual questions, come see Sean or I.